All right, good evening. Welcome to tonight's webinar, How to Invest in the Stock Market Profitably. My name is Tyler Ballhorn. I'm the founder of Stockscores, and I've been trading the stock market for a little over 30 years. I'm going to talk about my approach to the market, approach to trading, approach to investing, and just kind of walk you through the theory first, and then we'll look at some examples, and then we'll actually do some searches for opportunity. Now, the market's in a bit of a corrective action right now, so I don't have much expectation that we're going to find a lot of good opportunities yet, but that will come soon. One thing that you should sort of understand is that the best markets come after corrections, and that is certainly the case after the COVID correction. And I think it's really important to not turn your back on the market when there's a correction, because, again, the best opportunities come after a corrective move. It makes stocks cheaper. It changes the psychology. People get into bargain hunting. And I don't know that you'd want to start buying tomorrow, although the market is approaching a zone where it makes some sense to be thinking about buying. I'll show you that maybe tonight. But there will come a time when there's that big flush where everyone panics, dumps stocks, and then you get the best moves out of that. If you don't believe me, go look at what happened after the COVID crash, what happened after the little crash we had in 2011, in 2007, 2008, in 1999. It took a little while in 2000 before the market started to rally, but you had great bull markets that came out of those weak periods. All right, so here's the itinerary for tonight. I'll talk a little bit about how I got started in trading, the story about how I came to develop my methodology, and sort of the theory behind my methodology. It all started when I was a university student many years ago. What I focus on when I'm looking for opportunities, how long it takes to apply my approach. If you want to manage your own money, make your own decisions in terms of picking stocks, that kind of thing. I will show you what I focus on and the process and how long it takes. It doesn't take a lot of time if you want to just be an investor. I'll give you a little tour of the Stockscores Education Center, where I put a whole bunch of videos and write-ups and things like that online for people to learn from. And at the end, we'll do a little search for opportunities using a tool called the Market Scan, which is available at stockscores.com. All right, so let's start with the story of how I got into trading. I was a university student back in the late 80s, I guess, and was in business school, thought I should learn something about the stock market. And so I entered a stock trading game, a trading challenge, and really enjoyed it, kind of got hooked on it. Started to, become in a friend group with a lot of other people that like to mostly trade penny stocks, because we were all broke students. We didn't have a lot of money. I started with maybe $3,000, some of which I borrowed off of my credit card when I was 18, 19 years old. Bought my first stock, some penny stock that was in the oil service business. Lost money on the first trade that I ever did. But I really got fascinated with the market. Now, I was in business school, so I was learning how to do fundamental analysis and kind of the things that they will teach you in business school. And did that for a while, a couple of years probably. Really didn't have a lot of success, do some good, some bad, but overall I wasn't really doing great. And then I met this very peculiar guy, and I emphasize peculiar because he was quite peculiar, who introduced me to stock charts. And I thought, well, how the heck can you possibly predict where a stock is going to go by looking at its chart? Isn't it all about what companies do, how they grow earnings, who the management is, that sort of thing? And he wasn't great at doing chart analysis, but he introduced me to the idea, and then I started researching it on my own, looking at the chart patterns of stocks that had done really well. Now, when I first started doing this, I actually wrote out the charts by hand. So I had a year's worth of newspapers, and I would plot price charts on graph paper, one day at a time, using the newspapers. Now, you don't have to do that anymore, of course. Back then, it was really hard to get charts, especially up-to-date charts. And there was books that they had at my business school library where you could get old charts, but to get like an up-to-date chart was quite challenging. The internet was sort of in its infancy, and it wasn't easy to find those things. So I started out writing out charts by hand, and it's obviously very time-consuming, but it's actually a great exercise because you really start to get a feel for how price moves and how there are things that seem to come early in a trend. And so I started to reverse engineer the stock market. I went to those charts that were in my business school library. I looked at the charts that I was drawing out by hand for all the stocks that had done really well, and realized that there were these patterns that tended to occur before stocks went higher. And I would say I have maybe an abnormal aptitude for seeing patterns in things. And I basically taught myself how to read charts looking at these patterns. Now, at the same time, I was in my last year of business school, and I took a class where we looked at the big mergers and acquisitions of the 1980s. So, there was a lot of companies buying other companies in the 80s. Typically, they would pay a lot more than what the stock had been trading at. So, for example, R.J. Reynolds bought Nabisco. I have no idea of the price anymore, but let's say Nabisco's stock was trading at $30 and R.J. Reynolds does their offer to purchase at $50. If you knew that that news was coming, you could buy it around $30, and then when the news came out, the stock jumped up to 50, never traded in the middle, just went right from 30 to 50. And obviously that was a very lucrative exercise. And there were people who were getting this inside information on these deals to take advantage of those things. And if they knew that information in advance, they could buy the stock and make a very big profit. And that was a very common thing in the 80s. You might remember there's a lot of characters, Ivan Boesky, Michael Milken. They were trading on inside information, either in the stock market, in the bond market, and making hundreds of millions of dollars from that. So in this study that we did in my fourth year business school class, we analyzed the market statistically to look to see whether there was statistically significant abnormal trading activity in these stocks before the announcement of one of these mergers or acquisitions. And the hypothesis was, if there were large investors that knew that these deals were coming because they had inside information, they would create abnormal activity because they would buy the stock aggressively. And in doing that aggressive buying, the stock would go up more than it would normally go up. It would trade more volume than it would normally trade. And so we did this mathematical analysis of all these big mergers deals from that time period, and found on the vast majority of those mergers and acquisitions, there was in fact evidence of insider trading in the market activity. And then that really made it click to me why you would look at a stock chart. You're not looking at a stock chart because it's got a head and shoulders pattern or because it's got a RSI that is at this level and a stochastic at that level. Those things are indications of what people are doing with their money. And so I began to develop my own brand of chart analysis, which was, I would say, much simpler than what you would read about in a technical analysis book. And it really focused on looking for evidence that some people were trading on better information than others. And as we go through examples, we'll see that tonight. I'll show you the Twitter chart and show how it started to show signs that something was going on a couple of weeks before Elon Musk announced that he was going to buy the company. All right, so I've done this study in university. I've realized that market activity tells a story. It predicts the future. I'm also reverse engineering the stock market, looking at charts and looking for patterns that occur over and over again. I'm spending hours and hours and hours a day, quite joyfully. I really did enjoy it, and I still enjoy it. But I'm developing an approach to the market that is certainly not being taught in my business school. Business school is teaching me how to look at ratios and fundamentals, and I was doing that as an investor, and it just wasn't working for me. So then I start to apply this thinking to the penny stock markets in Canada. I grew up in Calgary, which is an oil and gas city. Lots of startup oil and gas companies, lots of big oil and gas companies as well. And the idea there was, these little oil and gas companies, if they found a new deposit of oil, their stock would jump up on the news that they had made this finding. But I applied that math that I learned in my university class to the trading activity of these small oil and gas and mining companies, and found that it happened there as well, that before big news announcements, these stocks were trading abnormally. When I say abnormal, it's statistically significant abnormal. So you can use statistical analysis of trading activity to identify outliers, things that really don't make sense. And it visually shows up, and I'll show you some charts in a moment where you can see this, but it is really quite visual. Now, the problem was, because I was developing my own method, there wasn't tools out there for me to use. The tools that were available, I could get normal stock charts. And now the internet's, this is a few years later, the internet's a little bit more available. You can get stock charts on the internet. There was services where you could download charts. So getting charts wasn't the problem. But doing the statistical analysis was extremely time consuming, because I was having to do it one stock at a time inside, Microsoft Excel. And this is a long time ago, so computers were a lot slower. To do it for one stock would take me a couple minutes often. So I needed to build my own tool. And, the first tool I built used this idea. Some of you who've been around with me for a long time might remember something called Orex Market Masters, but that was a long time ago. And then maybe 22 years ago, I started Stockscores. And I partnered up with a software development company, and we built the Stockscores website. And really what we were building was my own tools. And I was scratching my own itch. I was just trying to find a more efficient, effective way to find opportunities with this idea that you focus on abnormal activity, and then you apply the reverse engineering of the stock market work that I had done, and you can identify some good opportunities. Okay, so I didn't have the right tool, so I made my own. So what was the theory behind all of that? Well, my goal as an investor was to find market-beating stocks. I didn't want to, invest and earn what the market earned. If I wanted to do that, I could just buy an index. That's something that my business school education had taught me. The stock market averages around 8% a year. And if you can earn 8% a year, you can grow wealth steadily, slowly, consistently. Some years it'll earn more, some years it'll earn less, but on the average, it does very well over the long term. But I wasn't satisfied with that. I wanted to find those stocks that could move 100% in 6 months, or even better in a shorter time period. And I thought of those as market-beating stocks. Today I call those alpha stocks. Alpha stocks are those that are trading on their own story. They are driven by fundamentals that are better than the overall market. And most stocks, most of the time, are not alpha stocks, but there's always alpha stocks in the market. So this is an example of an alpha stock. This stock a year ago was at just a little under $6, right? And when I made this presentation yesterday, it was at, what's the price there? I got my scale on the side here wrong. It was at $15, or today, no, I think that's yesterday, $15. So that's a big move, you know, that's a market beating stock. Now there's patterns in this chart that I'll teach you a little bit of tonight, but I developed my own indicator, this stock score indicator. And when that green line is above 60, that's a good thing. When the blue line jumps up above 80, that's a good thing. And that algorithm is looking for characteristics of chart patterns. So, you know, for example, here you're breaking through resistance from optimism with abnormal activity, with abnormal volume. Well, all of those things get a score in the stock score algorithm. And so when you see these green lines above 60 and the blue line above 80, understand that that's represented by a scoring model that looks basically for things like this: breaks through resistance from optimism, from low volatility. If you were able to watch my webinar on Saturday, we talked about that. We talked about how to read chart patterns. We talked about the importance of seeing optimism and low volatility. And if you didn't do that, go to YouTube, go to the Stockscores channel on YouTube and watch the video on how to avoid stock market crashes and find hot stocks. I go into that, the stuff that in that video. Today, I want to go a little deeper into some other things. So I'm going to assume that you've either seen that already, or if not, you can watch it today, tomorrow, whenever. Okay, so this is a market beating stock. This is an alpha stock. Now, it's not always alpha. You know, here it was, here it was underperforming the market. Here it was underperforming the market. But in the long run, it was beating the market with a consistent upward trend. These are the kind of stocks that we love to own long-term, kind of stocks we love to put in our retirement portfolio because they're in a long-term upward trend. Sometimes they run away from it, but they come back, they run away, they come back. And sometimes there's breakouts, sometimes there's breaks of pullbacks. These are all potential buy points. You never want to buy a stock when it's way above its trend line. You want to buy it when it comes back to the trend line and breaks the trend line. You see that a couple of times. So there's a number of different strategies that we can use to take advantage of alpha stocks like this. And I'll show you a little bit more about that later on in the webinar. Now, why do stocks move in strong trends? Why do they outperform? There's a few answers to that question. Typically, the fundamentals of the company are improving dramatically. Now, that can be for two reasons. You can have fundamentals that are improving because the company is going out and doing good things specific to it. So a biotech company that discovers a treatment for cancer, that's very specific to that company, and that stock is going to do well when they make that discovery. An oil company that discovers a new deposit of oil is going to go up because they have made that discovery and therefore improved their capacity to have earnings. But there's also what I call the sector factor, which is, if a sector is doing well, so for example, the energy sector has done well for the last year and a half because oil prices have been going up. So therefore, the earnings power of oil companies has improved, and that has made many of those stocks outperform the overall market because they're making more money because of the price of oil. It's not really specific to the company, they're just in the right industry. So stocks move in strong trends for alpha factors and beta factors. Alpha factors are those directly attributable to the company and what they're doing, and beta factors are those directly attributable to the market that they're in. So the oil sector, the biotech sector, whatever sector of the market, the airline sector is starting to do well again, and money just flows into those. And so if we look at an example, here's a stock that outperforms the market, and it telegraphs that a number of times. Anytime you have a stock making abnormal activity with an abnormal price jump, with some abnormal volume, those things stand out on the chart. Those are things that my algorithms are looking for. They're looking for breaks from low volatility. This one wasn't particularly good because it was in a downward trend and it didn't really go anywhere from that. But this one was good. It started the upward trend. This one was really the best. It broke through resistance. This is a pattern called a cup and handle pattern. It's got a little cup here, a little handle, a breakout, strong volume on the breakout. That's it, $13. It hits $26 a couple of months later. Those are the kind of things that we want to see. But notice that as long as that stock was trending upward, the sentiment stock score, that green line, has more or less been above that important 60 threshold. A couple times it dipped down when the market was falling here, but generally it's been pretty high. And I guess the lesson here, and this is extremely important, is to never argue with the market. The market is always right. There are times when the market doesn't seem to be right, but even if the market's wrong in its assessment of fundamental value, if it's going up, it's going up. And I don't care why stocks go up. I don't care if they deserve to go up. I just like to own stocks that are going up. And I'm pretty sure most of you do as well. And my approach to the market is not to worry about what the company is doing, what the management quality is. I really couldn't care less, because all that matters to me is the stock likely to go higher after I buy it? And, I've developed a methodology to find stocks like this. I've built the tools to find stocks on that day when they trade more volume than normal, when they have abnormal price action. I've developed a methodology to know where to put your stop loss order so that you don't take big losses when you're wrong. So in this case, it would be right around in there. And it works well. It's worked well for a very long time. And as long as you understand the principles and you learn those things well and you practice, anyone can pick good stocks, regardless of whether you have a background in finance or whether your background is in growing marijuana. I don't know, like anyone can do this. Okay? So, stocks move in strong trends because new information about that company's ability to make money is coming into the market. However, the spread of information is not fair. And this is something I learned back in those days when I was trading penny stocks, that there was always some people that knew more than the rest of us about a particular company, about what they were doing. The mining company, there was always someone that knew the results of a drill program before the news came out. Energy companies, there's always somebody that knew about the results of new drilling programs for oil before the news came out. And I concluded early on in my years when I was still in university that the stock market really isn't fair, that most people don't get good information. Most people are trading on information that is public, but the people who really do the best in the market, they're trading on information that most people don't yet have. And a great example of that is Twitter. So Twitter started to behave abnormally right here. It broke this downward trend line, which is an important pattern. It had built a rising bottom, which is a sign of optimism. We talked about all this on the Saturday webinar. The volume, it's hard to tell, but the volume was actually quite a bit higher than usual starting there. Again, it gets skewed because of the big volume there. But all of that happened middle of March. And what's important to keep in mind is in the middle of March, most of the social media stocks were not doing this well. So Twitter was really standing out. Now, as I said, the stock market isn't fair. There's always someone that knows more than the rest of us. And I would argue that there were people buying here, and Elon Musk being one of them. He was buying the stock somewhat aggressively to build that large position that he built before it was announced that he was making an offer for Twitter shares at $54.20. Now that was announced right there. And the next day it went up pretty close to $54.20. I think it actually hit it. And then it pulled back a little bit because people sort of doubted that the deal was going to go through. And then right here, it broke this little pullback, and that shows up more on an intraday chart where the price action that we're looking at is say an hourly chart, I could actually show you that. I'll just jump over to the Stockscores website, pull up Twitter, and just make this a 15-day chart, because you can see on the 15-day 30-minute chart that it was kind of drifting lower, and then it started to stabilize, and then it had an abnormal move. And then, of course, yesterday the deal was formally agreed to by the board. It still may not go through, by the way. It's not conclusive that it will go through, but it seems like there's a better chance now than there was a week ago. All right, so anyway, the point of me showing the Twitter example is just to demonstrate that the stock market isn't fair. So we have this method then, and I talked about this in the Saturday webinar, and again, I really encourage everyone to look at that because it lays down a lot of the methodology in terms of how to analyze chart patterns. This is something called an ascending triangle pattern. It tells a story about how information is being priced into the stock, and when we get breakouts from a pattern like this, there's about a 70% chance that that stock is going to go up. And I teach maybe a dozen different patterns that all are predictive. However, when I say 70% chance that that stock is going to go up, that also means that there's a 30% chance that it's going to go right back down again, because the people that bought here on this breakout were wrong. They were speculating that something was going to happen. It didn't happen. And we have to go into every trade knowing that there is a possibility that that trade will not work. And this is a key component to investing effectively, is to having good risk management. And good risk management means planning your losses. So if you have a stock that's building one of these predictive patterns and then it trades abnormally and it breaks out of the pattern, you need to know where to put your stop loss point. And what I like to do is always put my stop loss point below the last inflection point. There's another video from the last week or two on my YouTube channel. This is all free stuff that you can watch, where I talk about, where do you put your stops? Should you use stops? I explain that in a video. And again, go to the YouTube and just go to the Stockscores channel. It was maybe 3 or 4 videos ago, and it'll have the word stop loss in the title. You can learn about that. But just for now, I'll tell you simply, if you buy here and your last little floor, your last little valley is there, you always put your stop right below that. And then that becomes the risk of the trade. And we're trying to earn some multiple of risk as the stock goes higher, and that represents the reward of the trade. And so this is a reward for risk of 1, 2, 3, 4, 5, and so on and so forth. Sometimes we'll get day trades. There was a day trade today that had a reward for risk ratio of, I think, better than 30. But anything better than 5 is excellent. And if you can average a reward for risk of 2, including your losers, then you can consistently make money in the market. It's a very different mindset to how you make money as an investor. It becomes a numbers game. We buy 20 stocks a year, 10 stocks a year. We expect to lose on 65, 70% of those. Or sorry, we expect to win on 65, 70% of those. We expect to lose 3 or 4 times out of 10. But if our average profit is double our average loss, and we are right 70% of the time, then if we do 10 trades, we expect to make money. And that's something called expected value of a strategy. So if we have a strategy that's right 70% of the time, and it makes 2 times what it loses 30% of the time, and let's say you lose $1 when you're wrong and you make $2 when you're right, that means you have a expected value that is positive. 1.10 is a positive number. That is a positive strategy. What I just did in 20 seconds is a half an hour lesson in my course. So if that doesn't make much sense to you, don't worry. You can learn all the details of that, but it's an extremely important concept because most investors, they don't limit the size of their losses. They're wrong some of the time, even if they're good stock pickers. They're wrong some of the time, and they end up taking big losses some of the time. And those big losses, instead of it being a -1 loss, it could be a -10. And now all of a sudden, even though they're right 70% of the time, they're actually losing money because the size of their losses is much too large. So when we go into a trade, we always plan to lose. And that may seem counterintuitive to some of you, but we always plan to lose when we enter a trade. And what do I mean by that? Well, this is a stock that I found on this day right here, the abnormal action, abnormal volume. It had broken a downward trend line. It was building rising bottoms. This is something called a bottom fishing pattern. Great setup. 70% chance that that's going to work. Well, it didn't work. So in this case, the stop loss is right around in here. And 2 weeks later, it closes below the stop loss point. So I'm out. Exit, loss. Small amount of pain because I've planned for it. Because you see, when you buy this stock here and your stop loss is there, you can calculate the risk of the trade. So I'm going to round these numbers off. Let's say the entry is $5.50 and the stop is, I don't know, looks like about $3. That means you've got $2.50 a share in risk. On a percentage basis, that's quite a high number. It's almost 50% risk. But because it's such a volatile stock and because the risk in dollar terms is so high, you just buy less. And so if you're only willing to lose $250, then you buy 100 shares. If you're willing to lose $2,500, you buy 1,000 shares. And so what most investors don't do is they don't do this calculation to figure out their position size. What they instead do is say, well, I've got $10,000 in my account. I can afford to buy, 1,500 shares, a little more. And they don't think about what that means in terms of risk. And all of a sudden, the trade doesn't work and they're staring at a $3,000 loss in an account where they had $10,000. That's hard to swallow. And because it's hard to swallow, what do? They don't take the loss. Human beings avoid pain. We pursue pleasure. And so if the loss that you're faced with is too big for you to stomach emotionally, you don't sell. Because in our heads, we fool ourselves into thinking that we really haven't taken a loss until we sell. Well, if it's trading at $3 today, that's what it's worth. Now, if it goes back up, great, but it could also continue to go lower and lower. This stock could go to $1. So I always plan to lose, but the key thing is I put that stop loss point below the floor that's defined by the market. And again, I went into that on Saturday, and there's a whole video from the last couple of weeks on the Stockscores YouTube channel about that. We don't have enough time to go in all the details, so you can watch those videos instead. All right, now the last thing I want to talk about in terms of the theory behind the Stockscores approach is kind of the opposite of the first one, or don't expect to be right all of the time. It's also that when we are right, we have to let the stock work. Now, just a moment ago, I said human beings avoid pain and pursue pleasure. So they avoid taking losses when they're wrong, but it also means they're often quicker to take profits when they are right. And a lot of people limit the upside on the stocks that they own because if it goes up 30%, they just say, oh, I'm out. I'm going to sell it, and I'm not going to be greedy. Never go broke making a profit. These are the stupid things that people say to themselves. The problem with that approach is that your winners have to pay for your losers. And so you need those stocks that come along once in a while that make 100%, 200%, 300%, because they're going to pay for a lot of losers. But if you limit the upside on the stocks that are winners to, always selling a stock if it goes up 30%, you're really not balancing out against the losers. And there will be losers. I don't want anyone to ever get into investing and trading with the belief that they're going to be right 100% of the time, because no one is right 100% of the time. And coming back to that expected value equation, we have to balance the losers against the winners We need our average profits to be higher than our average losses, and we need the probability of success to be higher than the probability of losing. All right? So if we look at this stock, it first started moving here on this breakout, very similar to that failed chart that I showed just a moment ago. This one has rising bottoms. It breaks the resistance. It had broken a downward trend line. It's got all the check boxes filled for my bottom fishing strategy. And you can see it went for a nice run. You could maybe sell there and then maybe buy it back here on a break of the pullback. Or you could just define your long-term upward trend line like this, and the stock's still doing well. It started that move at, what, 40 cents? And today it's at $2.40. So it's up 600% in a year and a half. It all started with abnormal volume, abnormal price action, stock scores in a good spot. This is a weekly chart, by the way. So on the daily chart, you would have had a spike up on the daily chart. On the Friday, the signal stock score had fallen back. Don't worry about that. And this stock has been a great mover. It also had, so it had this pullback break here and here. So those are pullback plays. Had another one there. It had a break from a cup and handle there. This stock has been giving buy signals numerous times in the last year and a half. So when they're working, let them run. So what do I focus on when I'm looking at charts? Well, this will be a little review from what we discussed on Saturday. But number one and most important is I want abnormal trading activity. I want the stock to be trading abnormal volume, abnormal price action, because that tells me that something is going on. There was abnormal price action, abnormal volume in Twitter a week and a half, 2 weeks before the news came out. There, almost every upward trend, every market-beating upward trend, I'm going to say 95% of them start their long-term upward trend with abnormal trading activity. Happens over and over again. The problem is, while almost every upward trend starts with abnormal activity, not all abnormal activity leads to a market-beating trend. So I'll say that again because it's really important. Most market-beating stocks start their upward trend with abnormal activity, but not all abnormal activity leads to a market-beating trend. And that's why we must look at predictive chart patterns. As I said, there's a dozen that I teach, maybe a dozen. One is this ascending triangle pattern. It has rising bottoms, which is a sign of optimism. It has a line of resistance. It has compressing price volatility. These are all things that I teach in the Stockscores Education Center, which I'll show you in a moment. And then it has the abnormal price move out of the pattern. And we know from analysis that that has a roughly 70% chance of leading into an upward trend. So when you get abnormal activity, great. Then you have to check the chart pattern. Is it a predictive chart pattern? Yes, it is. Great. Then you have to say, okay, what's my risk management? I'm going to be buying here. I'm going to plan to lose here. The difference is the risk. I divide the risk into my risk tolerance to calculate the number of shares. If the trade is working, we're going to be patient. As long as that upward trend is intact, as long as I don't have a sell signal, I'm going to stick with the winner. I'm not interested in trying to get in at the low, trying to buy stocks down here. That's a tough game. It comes down to luck. You're better to pay more and buy the breakout than you are to try to anticipate what stocks will be strong. You have to wait for the message of the market to tell you what to do, which means you're always going to pay up for a stock. And again, it seems counterintuitive. Don't we want to buy things when they're on sale? Don't we want to buy weakness? There are times when we do that, but generally speaking, no. We want to buy strength, but we want to buy the first show of strength. We don't want to buy the fifth show of strength, then we're too late. We want to buy when the stock just starts to move, when it surprises us with abnormal activity. So if we look at another example, here is a pattern called a cup and handle. It's got a little cup here with a handle over here. It's got rising bottoms, which is a sign of optimism. Look at the volume jump up as it breaks out with abnormal price action right there. That was early in February. Stocks done well since then. It actually went parabolic and did something called a bursting bubble right there. A bursting bubble is a pretty good sell signal when stocks go into a parabolic trend. We often sell at those bursting bubbles. So how long does it take to apply my approach for investing? Well, if you have 15 minutes a day, then you can do these strategies. And I'll show you where these strategies are taught in a moment. And these are the primary ones that I do. Mostly this one right now. Bottom fishing will become a good strategy when the correction sort of runs its course. Bottom fishing generated so many good trades after the COVID crash. Stocks that went up to 300% was awesome. And now we're in a new corrective phase, which I don't think is over yet. And so this is going to be a good one to watch, not next week probably, but in the weeks ahead, hopefully. All right, so those take 15 minutes a day. Now, when you first start doing it, it takes 30 minutes because you're learning. I can do this in 5 minutes because I've practiced for 30 years. So it's, you start at 30 minutes, you get down to 20, you get down to 15, and, you can even get faster and faster. We will do this process together in a moment for one of these strategies. I'll show you the process. Now, not everyone wants to do that every day. So then we have other strategies for people that want to just be longer term investors with 15 minutes a week. So if you can find 15 minutes on the weekend to do some market scans, then these are the strategies you're focusing on. And in this case, you're trying to find 10 stocks a year. In this, we're trying to find 30 to 50 a year. But they don't come on a steady flow. It's not like one a week. Some weeks you'll have 5, and then you go 5 weeks with 0. It's all about what the market is telling you to do. So they tend to come in clusters. We got a whole bunch of energy stock picks, a little over a year ago when that sector started to turn. We had a bunch of biotech stocks moving well when the market was fairly hot for the small cap stocks. Okay, so really important to understand, we make 80% of our money 20% of the time. I'm not doing a lot of position trading right now because there's really not a lot of good quality opportunities because the market's going lower. It also means that portion of my capital for position trading is in cash. It's just waiting. Waiting as an opportunity is coming. There's okay day trading opportunities every day. I'll talk about those on Thursday's webinar. There's a few good day trades every day. Certainly not great, but there was one today that went up huge. And again, I'll talk about that on Thursday. Tonight, we're talking about longer term trading, investing. So how do I find opportunities? Well, I built this tool. I told you the story 22 years ago. I made the first version of that tool. We're on a few versions on to that, and that's called the Stockscores Market Scan. It allows you to scan the entire North American stock market in minutes. It's a huge time saver. What used to take me hours, I can now do in 5 minutes. It has filters that are unique to my approach. Remember I said I was scratching my own itch. I had to build tools to match my theories, my approach, that I couldn't get other places. And you really can't get the kind of things that we do at Stockscores in other places. They're very unique tools. And it's all about saving time and focusing on making money. So let's go to the market scan. And at the end of the presentation tonight, we'll actually do a scan together. I just want to show it to you now. So this is the market scan tool, and it has all these filters available to you. So I could say, show me all the stocks on all Canadian markets that pay a dividend yield of at least 3%, that are between $5 and $50, that had an abnormal day to the upside, probably won't have any of those today, and traded at least 500 times. Now, because of what the market has been doing the last few days, I don't expect much from this, but let's try it anyway. Oh, found one, Parkland Fuel. So I can look at PKI. I can blow this chart up. I can see that it went up a little bit today. It pays a dividend of 3.8%. But when I look at that chart, I have no interest in it. The Stockscores market scan is a way to put a small number of charts in front of you to look at. Now, I just built a scan on the fly using some of these filters, and there's a whole bunch of them. You can see them all here and sort of view them there. But there's also preset market scans. So if I don't want to build my own scan, I can use one of the presets. So I can run a scan called Abnormal Breaks Canada, which looks for all the stocks on the Canadian market that had an abnormal break today. Wasn't too many, 2. And again, that's a function of the market. I could run a scan called Bottom Fishing US, which looks for that pattern where stocks are breaking from a rising bottom. So there you see that pattern. There's a downward trend, build of a rising bottom, breaking from a rising bottom today. Volume a little higher than normal. It's not bad. I'd give that a 6 out of 10. Okay, so huge time saver. Now, normally when you do these scans, you'll get 30, 40 stocks to look at. We're only getting a few here and there just because the market's been correcting the last few days. And that's what you want. You know, I'm happy to be sitting in cash right now. I'm not suffering losses like so many people are. I am, in cash waiting for this correction to run its course and then start snapping up bargains. Okay, so that's the market scan tool. We're going to come back to that tool at the end tonight, and I will we'll actually run a scan together and we'll analyze some charts. Okay, so that's the market scan. Now we also have an area of Stockscores called the Education Center, and this is where you can learn my approach. So, tonight in 45 minutes or so, I've taught some things. I've got lots of videos on YouTube where you can learn little bits and pieces of my approach, but the in-depth knowledge for my approach is taught in this Stockscores Education Center. So there's 3 functional areas. There's the foundation area, which is theory. It's how to read a chart pattern, how to know where to put a stop, how to scale into a position, how to size a position, how to know when there's a sell signal, all of those things. And so there's, 12 or 14 different modules in the foundation. For every module, there's a written component, a video, an assignment, so you can see if you understood what was taught, and then a little test to make sure you understand it. So that's the foundation. The investor section of the Education Center teaches my investing strategies. So this is for people that don't want to spend more than 15 minutes a day or 15 minutes a week on the market. You're going to focus on the investor strategies. If you want to be a day trader or a swing trader, you will focus on the active trader strategies. We'll talk about those on Thursday. And again, you can register for those webinars on Thursday and on Saturday, this coming Saturday, in the upcoming events area of the Stockscores website. Okay, but in that section, written lessons and videos explaining the rules and the processes for that strategy. So if we go back into Stockscores, go to Trader Training, Education Center. Now this is a member-only area. You have to be a member of Stockscores. I'll talk about that in a moment. But here's all the foundation lessons. I said there was 12 or 14. I'm not exactly sure. 2, 4, 6, 8, 10, 12, 14, 16. There's one on options basics, how to create a trading plan, risk management, expected value. We talked about that a little bit tonight. And there is a written lesson explained here. There is a video, which I can watch from a computer, an iPhone, whatever. And this is a 12-minute video that explains expected value, one of those things we talked about earlier. So it's all in the Education Center. Now, if I go back to the Education Center and I can go into the investor section, here I see strategies. So there's the exit rules. There's the Stockscores Simple Daily, the weekly, the abnormal breaks, the simple ETF. So Stockscores Simple Daily Strategy. Okay, that's where I learn the rules. I can watch a video. I can read a lesson. I can print it out. But I can also then go into the market scan and select the Stockscores Simple strategy right there. I can select it for Canada or the US. So I can select Stockscores Simple US, run the market scan. It found 11 stocks. The lesson tells me what to look for. And I look at this chart and I say, yeah, that's pretty good. We'll come back to this and we'll do this scan after I'm done the major part of the presentation. So later tonight, we'll do that. So when you take the investor course or get the investor membership to Stockscores, you get access to the foundation lessons in the Stockscores Education Center. You get access to the strategies, the explanations for when to buy, when to sell, the processes for identifying opportunities. You get access to the market scans on Stockscores. You get email support from me as you're learning and getting better at this. Your membership includes 6 months access to that tool, the market scan tool, which you then renew for $300 a year. The active trader course I'll talk more about on Thursday and Saturday, but it's everything that's in the investor course, but you also get active trader strategy. This is for day trading, for swing trading, for those of you that have an interest in that. And again, I'll talk about that more on Thursday and Saturday in those webinars. What Active Live is, I'll tell you about that on Thursday. What these indicators are for TradeStation, I'll teach you about that as well. So come back Thursday if you have an interest in day trading and swing trading. We have a service for our day traders called Active Live. Again, I'll talk more about this on Thursday, but essentially with this service, you're watching my analysis screen in real time all day long as I run really sophisticated algorithms that pull out the stocks that are moving in the first 2 minutes of their move. So very, very much on top of things. It's a tool that gives us an edge over most traders just simply because we find things earlier. And again, if you have an interest in that kind of thing, come back Thursday and we'll talk about that. Now, twice a year, I complement the online trading that is in the Stockscores Education Center with some live training, and this should be May, some live training that I'll be starting on Monday, May 9th. So Monday, May 9th and Tuesday, May 10th for an hour and a half each night, I'm going to teach you all the theory. So 3 hours of classes those 2 days. These are all recorded, so you can watch them later as many times as you want, or if you play pickleball on Tuesdays and you can't make that session, then you can watch it after the fact. It is better to watch it live because you can ask questions live and I'll answer those. And then the Wednesday, Thursday, and Friday, we will run some market scans together each night and try to find opportunities. So we're now going to practice what we've learned on Monday and Tuesday. Now, if you're an active trader student, so this is for investor students and active trader students. If you're an active trader student, you also get this bonus of 1 month on my Active Live service. I'll talk about this tomorrow, or Thursday rather. So this live training, which starts May 9th, that's for anyone that becomes a member, an investor or active trader member of Stockscores before Friday, May 6th, which is the cutoff for this special offer. So anyone that registers for the investor or active trader course before Friday, May 6th at 11 p.m. will receive that overview class, will receive those strategy application sessions Wednesday, Thursday, Friday, plus a little surprise bonus that I'm only going to tell you about later on. A little bit of extra practice that will help you with. So again, the overview class, May 9th and 10th in the evening. The investor market scanning, 11th, 12th, 13th. Active Trader live trading is available as a free month for whenever you want to if you are part of the Active Trader group. We also have something called mentorship. I'll talk about that more on Saturday. That's for a small number of people who can register for the mentorship, where I will take you through all of the course material, kind of hold your hand through it for those that would like me to walk them through it one class at a time. We do 14 hours of live webinars coming up starting in May. Again, I'll talk about that more on Saturday. Space is limited for that. So if you have an interest in that, make sure you're there on Saturday for that webinar. So pricing, investor course, $2,495. This is Canadian dollars. That includes 6 months of the tool access. And then after that, it's $300 a year. And you get 6 months for free when you register, and then it renews you at $300 a year. You can always cancel anytime. Active Trader includes investor. That's $3,495. I'll talk about that on Thursday. Mentorship includes Active Trader, includes investor. That's $54.95. If you took the investor course a year ago, let's say, and you want to upgrade to active, you can do that now for $1,250. If you took the active course 2 years ago and you want to upgrade to mentorship, it's a $2,000 upgrade. If you took the mentorship before and you want to retake it, it's $1,000. Again, all of this stuff and pricing and stuff like that, I will go into more detail on that on Saturday. If you would like to register for this course, you can do so on the Stockscores website. Go to Trader Training, learn how to trade. There's a couple of videos on here that go into more detail about what each course includes and what's in it, and you can register right there on that page. I will go into a lot more detail about these courses on Saturday, but you can register at any time. The deadline to get the free bonus stuff is May 6th, which is Friday, May 6th at 11 p.m. But the sooner you register, the sooner you have access to the material, the sooner you can start working through it, and then you can be that much more prepared for those bonus live classes that I'm doing. Okay, so here's some comments, and while those comments are going up, I'm going to just put up a little poll, because as I say at every presentation, I don't really like to bug people. So if you would like more information on the courses, you can answer this poll. I'll just put that up now, and you can see what the interest is. If you don't want an email from me, I'm only going to send 1 or 2 follow-up emails. Just say no if you don't want any of them. If you want to learn more about these courses, let me know what your interest is: investor, active trader, or mentorship. And I'll leave that up for a moment, and then I'm going to answer some questions, and then we're going to do a market scan in search of opportunity. Okay, I'll leave that up for another 10 seconds. I'll just take some questions, or I'll try to answer some questions that are here now. Is Wealthsimple any use to trade with our new knowledge? Well, Wealthsimple is a broker that doesn't have commissions. So in the US, there's one called Robinhood. Wealthsimple is the same kind of idea in Canada. I'd be very cautious about these no-fee brokerages, because brokers have to make money somehow. And so there's no free lunch. If you aren't paying a commission on your trades, then you're probably not getting the best fill price in the market. They're making money off of you somehow. So I don't know, a lot about any of those commission-free brokers. I don't use them. I find that they're too slow for my order entry, and that I may not get the best price in the market that I would get if I went through a normal commission broker. Is mentorship during the day or evening? Most of the classes are in the evening. There might be a couple shortly after the market close, but they're all recorded. Someone asking how have my strategies evolved. So they read my book. Since writing it in 2013, how have your strategies evolved? Well, first, I'll say that I don't really put my strategies in that free book. I don't want that many people to know my strategies. So the strategies that I actually use are, I'm just going to take this poll down, are more so taught in the course. And a nice thing about having those strategies online is I can evolve all the time. So I'm actually, once I'm done the webinars this week, I'm actually going to be doing the active trader videos over again. I want to bring in some of the improvements I've made, the evolution of those, that sort of thing. Someone asking about Disnat. Disnat used to be awesome. They used to really be focused on active traders, and then they sort of migrated away from that. So I'm not too aware of what they offer now, but I no longer use Disnat. I personally use Interactive Brokers, which I think is a good broker, but they're not for everyone because they're kind of complicated. Their platform is pretty sophisticated. I think You just have to be patient when you're learning it because it does so much. It can be a little bit overwhelming. Other brokers that my students like, and here in Canada, are TD Web Broker, Quest Trade. A lot of people like that. I mean, the banks are all okay for investing. If you're going to be an active trader, I think you'd want to lean toward Interactive Brokers, Quest, or TD. Those are the most popular three among my students. When you do ETFs, are you interested in obtaining the distributions or just the price action? Well, I mean, both, I guess. I focus mostly on the price action. I don't really trade ETFs a lot, but and it's fine to trade them if you want to be an investor longer term. I personally look more at whether the value of the ETF can go up. If they have distributions, that's a bonus. Can you upgrade from foundation to investor? Yes, you can. The upgrade fee for that from foundation to investor would be $1,750. Someone had a question when I had ATH up, so I'll just jump back to that. T.ATH, they're asking, what kind of exit would you now plan for on ATH? Probably put support here at 190 if it were to close below that, or you could use an upward trend line, and if it breaks the upward trend line, say 215 or so, would maybe be an exit. Someone asking, I thought you were going to send everyone a copy of your last webinar. I sent a link to the video of the last webinar. Everyone that was registered for the last webinar would have received an email with a link to the video of that webinar. I'll do the same for tonight, by the way. If you don't receive that, it's probably the case that it went into a junk folder or a spam folder. But if you want to ever see any of my videos, just go to YouTube, and in the search box up at the top, type in Stockscores, and there you'll see the Stockscores channel with my ugly mug, and click on that, and you can see all the videos. They're all here. So here's the video. Whoops. Here's the video from Saturday right there, how to avoid stock market crashes. And you can click on it and watch. Okay, so if for some reason you don't get the email from me with the video link, just go check out YouTube or check your spam folder or your junk folder because it's probably landed in there. Someone asking, is trading contra ETFs when the market is bearish is something you recommend? So contra ETFs, I call them inverse ETFs, but so for example, TZA is an inverse ETF on the Russell small cap index. It goes up when the market goes down. It's another way to take advantage of markets that are moving down, absolutely. Many of my students trade these. I personally prefer to trade stocks, but yeah, you can do this. And if you look at the last 5 days of TZA, it's made a pretty nice move. So here is a pattern called a rectangle consolidation. It broke out. That's at around $32. Now it's at $39. That's in 1, 2, 3, 4 days. Pretty good sell signal right here though when it broke the upward trend line. And then it broke the pullback today and started up again. Okay, I'm just going to launch. Oh, I did the poll already. We're doing questions now, and then we're going to do a market scan. I'll do the market scan in just a minute here. I know some of you are waiting for that. And again, if you have questions about our different products, I will go into that in more detail on Saturday. So Saturday at 9 a.m. in the morning. And again, these are all free. Just go to Trader Training, upcoming events. So the next webinar is Thursday, the things you must do to be a successful day trader, Thursday, April 28th, it's free. Or Saturday, how Stockscores Trader Training can help you make stock market profits, free, Saturday, April 30th at 9 a.m. Pacific, 12 p.m. Eastern Time. You click on there to register, fill out this page that comes up, your name, first name, last name, email address, register, and that'll not only have you registered, but it also gets you on the list to get a free copy of my book. And we do email out the video link as well. If you don't get that, check your junk folder, your spam folder. Because if you're registered and you didn't, mistype your email address, it is sent to you. We don't, we send it to everyone. So, okay, let's do a market scan, because again, I know some of you want to get going. And so we were going to do the abnormal breaks, or no, Stockscores Simple US. I did that before, and I want to do that now. It finds 11 stocks. So this is the results page. It's got all of the stocks that it found. It's a pretty short list today, again, because the market's kind of lousy right now. I'm going to watch these or look at these in a slideshow. So I can select here, view in, right here, view in slideshow. I could also make a gallery, which gives you 10 charts per page. Slideshow gives you one big chart per page. And there it is, nice big chart. So reviewing mostly things we talked about on Saturday. We've got rising bottoms, so that's optimism. We've got compressing volatility. You can see the swings are getting less and less intense. You've got pretty strong resistance here at 60 cents. It's hit it once, hit it twice, stalled 3 times. Today it broke out. Notice the stock scores are in good spot. So it looks great. Now I'm going to tell you about the weaknesses. Weakness number 1 is it doesn't have any abnormal volume. So there's not a lot of enthusiasm. Now I can also make this a 3-year weekly chart to get some context. And you can see it's been trading under this mark for a long time. It may not have the volume to get through it. So if I was going to rate this, even though it's got great scores and it's got a lot of good things in that chart pattern, I would give it a 6 out of 10, which means I think it has a 60% chance of going up. Now, when you have reviewed the lessons and practiced this for a while, you're going to be able to do the same thing. Next chart. Okay, I see optimism, but I don't see a breakout yet, so it's not good yet. This one has been moving up for a while, don't particularly like that. And this is the process, is I just hammer through these charts, waiting for the right pattern. Now here I can see abnormal volume, abnormal price action. So those are good, but it's also below resistance. So what you're going to learn in the investor course is that matters. And that's a reason not to consider the trade. We always look at things on multiple time frames. I look at that on the 3-year weekly, and I see that it's probably going to get stuck here. Still got good long-term optimism. So it's a good hold, but I wouldn't buy it today. All right. Now I'm going through these one at a time, but if I wanted to be quicker, I could look at the gallery view, and then I can see all these little mini charts, 10 per page. And if I see something that interests me, I can click on it, blow it up, do that same analysis. I tend to use the gallery viewer because it's just quicker. I don't see anything that I love today. That first one was probably the best, but it was only a 6 out of 10. And then NXRT, no, too far into the upward trend. If I look at this 3-year weekly, here I can see the pattern that matters. So there's resistance there. See how it hit it once, twice, stalled for a few weeks. This is a weekly chart, and then broke out. Didn't have much volume behind it, but again, that's the weekly chart. But that started that upward trend. Started with abnormal price action at $57. Now it's at $90. It pays a 1.7% yield. If you're a member, an investor member of Stockscores, you will not only be able to use this tool, but you will be taught what to look for. We're going to start our training with those live classes May 9th, that week of May 9th. And you obviously have all of the online material that if you register for the investor course tonight, you're going to have access to it tonight. It's all instantaneous. And, within a little bit of time, asking me questions. I don't teach a lot of people, so I'm there one-on-one, well, not one-on-one, but by email to answer your questions. I don't have other people answering emails for me. I do all that myself. I sit in front of a screen all day, so when I'm trading, I have time to answer email, and I'll teach you how to do it, but you have to want to learn. Okay, so that's pretty much all I wanted to talk about. We went a little over time, but there was a lot to consider. A reminder, Thursday is our day trading webinar. Saturday is our webinar on the different course options and memberships. There's a question, can we subscribe to the fully functional scanner without the course? No, you cannot. You have to take the course in order to get the access to the scanner. And I'll tell you the reason why is I use this tool. I don't want a lot of people using it. I teach 100 people a year. and it pays for the tool. It's not cheap to run these things, all the market data and stuff like that that's required. I could have 5,000 students. I don't want that many. It's just, it doesn't make sense for me as a trader because the value of the tool goes down the more people use it. So the reason there's a $2,500 fee is, first of all, I think the information you learn is more than worth it. You will save yourself money and time in learning, taking my course. You just have to sort of buy into that concept, because I taught myself. It took me 8 years to figure it out, and I lost thousands and thousands of dollars learning. So trust me, this is a quicker and better way to learn. But there's also just the aspect of this tool is going to save you time and money in being able to do things. It cost me, I don't know, $250,000 to build the tool. People get to use it for $300 a year, $2,500 sort of initiation fee, if you will. So you get all that great information and you get access to the tool. I think it's a bargain. The price is the same today as it was 15 years ago. I probably should raise the price one of these days, but I just never get around to it. All right, so I'm going to wrap it up there. Hope you've enjoyed it. Hope to see you all Thursday and Saturday. And I want to thank you for your time tonight. We'll see you then. Thanks, everyone. Bye for now.